Hello everyone, welcome to another video. And in this video we are basically going to continue with this chapter 16, and the name of the chapter was You and Me. And if you remember, in the last video we were talking about financial bubbles, and now we're going to talk about the housing bubble, which happened in the mid 2000s. So during that time it didn't make much sense for someone to buy $70,000 two-bedroom house for the family, especially if they were planning to stay there for the next 10 years. It was a bit expensive, but it does make sense considering the fact that everyone was buying at that time, and what they were doing basically was they were flipping the house. They would buy the house, they would wait for the prices to go up, and then they would eventually sell it. In that case, if you were planning to do the same, then it kind of like makes sense to buy that expensive property. And this was actually confirmed by by data from financial firms, that the number of the houses that sold more than once in a time span of 12 months actually increased by five-folds. But then again, you probably have to ask a question that what would you call these kind of investors? Would you call them speculators? Would you call them irresponsible? We can call them a lot of things, but one thing that we cannot call them is irresponsible. Oh, sorry, we cannot basically call them irrational. The thing is, the formation of bubbles isn't so much about people irrationally participating in long-term investments, but rather it is about people somewhat irrationally moving towards a short-term trade to capture the momentum that had been um, building on itself, actually. Um, and and that sounds kind of reasonable, or rational, not reasonable but rather rational. The thing is, like, what would you do? I mean, you see that people are making profit, uh, and they don't have to actually wait for a long time to make those profits. So then I think it's natural for anyone, even for the people who have long-term investments in their mind, to basically take cues from the other investors, the short-term investors, and participate in the investing. Right? Nobody wants to sit back and watch others make money. So yeah, and this is where bubbles actually become a problem. It starts to become a problem when the long-term investors playing one game, they start to take their cues from short-term traders that are playing another game altogether. Let's take a look at the company Cisco. So their stock went 300% up, um, and it went to $60, and the company eventually was valued at $600 billion. And very few people actually thought that this is actually how much the company is worth. Some economists even said that that if the valuation of the company is correct, then according to their growth rate, the company would be worth even more than the US economy in the next 20 years. But the thing is, if you were a long-term investor at that time in 1999, $60 was the only price you had to buy that stock, actually, right? And then you might have thought like, okay, all these people definitely know something that I don't. Then it's better to probably follow them and buy the stock at that price. But the one thing that you didn't realize, or we didn't realize, was that the people who were actually setting the price of that stock, the short-term traders, they were playing a different game altogether. So for them, it actually made sense to pay $60 because they were gonna sell the stock by the end of the day with a higher price. But it didn't do you that much favor because you were planning on holding on to the stock in the long run. And in the long run, the price of the stock actually went low. So whenever you hear a commentator on CNBC say that you should buy the stock, then you should stop for a moment and think basically who you are. Are you a teenager who is basically looking to trade for fun? Are you a widow, an elderly widow that is on a limited budget? Or you are a hedge fund manager who is trying to shore up their books before the end of the quarter? So the thing is, in all of these cases, it's not a very good idea uh, to suggest that the particular price for a stock is good for them in all of these cases, because all of these three cases have different priorities, right? So it would be crazy to actually suggest that. So being influenced by people who are playing a different game can also throw off how you actually think about spending your money. Most of the consumer spending, especially in the developed world, is socially driven, and it is influenced by the people that we um, admire, and then it is continued because we want people to admire us. So we can see a lot of people spending a lot of money on different things, on cars, on vacation, and all of that stuff. But the thing is, it's really hard to see what are their goals, what are their aspirations, and what are their thoughts basically. So to look at an example, let's say there is a new lawyer who has to keep up with his appearance because he eventually wants to be a partner at the law firm. But if you compare it to an author who basically doesn't have to keep up with appearances, he can actually work at home in his PJs, more or less, right? So if the author starts taking up hints or cues um, from the lawyer, and also starts spending money the way the lawyer is doing on things that it doesn't actually need, because eventually the lawyer is going to get the partnership at the law firm, but for the author doesn't spending but for the author, spending all that money actually doesn't get him uh, the same thing that the lawyer is actually aiming for. So to summarize this chapter, the takeaway or the thing that we can actually learn from it, or the takeaway would be that first of all, we have to figure out what game we are playing. What is our time horizon? Are we in the market for the long term, or are we in the market for the short term? And the second most important thing is to be not influenced by the behaviors and actions of people who are playing a different game altogether. They're playing a different game from us. So hopefully you have learned something in this video, and I will see you in the next one. Bye bye.